Hi, this is Andy Hoffman, Marketing Director of Miles Franklin Precious Metals in our 26-year business. It's Saturday, January 31st, 2015, and the title of today's audio blog is Everything's Unraveling Now. Now, the markets just closed on an historic week, starting with the most destabilizing election of our lifetimes and ending with the abject failure of the PPT, Fed, and gold cartel to maintain market control. And as you can imagine, I'm just itching to comment. That said, I am yet again in the difficult position of trying to find an appropriate starting point, as there are that many horrible headlines to address. However, in scanning the day's developments, what struck me as most terrifying was the freefall collapse of global interest rates, which at this point is occurring more rapidly and relentlessly than during the heart of the 2008 financial crisis. Neither did I know that my May 8, 2014 article, The Most Damning Proof Yet of QE Failure, would turn out to be the most important I've ever written, describing how no matter how hard central banks try to, quote, save their economies, or at the least pretend they're doing so, the entire world will shortly realize there's no stopping the downward trend and act accordingly. My premise then was that the entire world would front-run the inevitable QE to infinity that any central bank that could would engage in. And by those that could, I'm referring to those not yet in the throes of collapse, as those that are, like Brazil and Greece, are experiencing massive interest rate surges as investors realize it's too late for QE, as even hope has been lost. In other words, Brazil and Greece's financial cancers are in their terminal stage, in the former's case causing the Brazilian financial markets to plunge and currency to collapse, and in the latter, a far more frightful stock bond and banking system implosion under the assumption that the soon-to-be-issued new drachma hyperinflates. Frankly, the market distortion caused by this, history's largest and only global fiat Ponzi scheme, are so gargantuan, even Russia lowered interest rates today, and this with the ruble already at an all-time low. Putting this insane move in perspective, reducing interest rates when your currency is in free fall is the equivalent of a fireman arriving on the scene, not with a fire hose, but a fire-breathing dragon, which is probably why the ruble plunged further to a new all-time low. As for the remaining non-reserve currencies, which is to say, all of them, it's quite remarkable to see currencies of supposedly first world nations collapse like those of third world nations. And yes, I realize that all currencies, the dollar included, have been slowly drained of purchasing power over time, but I'm not talking about a few percent per year, but dramatic declines in currencies as diverse as the Indonesian rupiah, Nigerian naira, Argentine peso, Turkish lira, and even the Canadian dollar, Australian dollar, and Mexican peso. And oh yeah, the euro and yen, with the yuan dollar peg sitting on a euro franc-like precipice that, as discussed earlier this week, must eventually break. In fact, as I write, so-called offshore yuan is trading above the pegged onshore yuan, or should I say trading below it, as investors speculate the yuan will eventually be devalued. And don't forget the currency combining the worst of all worlds, from massive debt to an unfettered printing press, the world's most concentrated derivative exposure, and enormous exposure to plunging oil prices, i.e. the British pound, which under the radar has fallen to the low end of a 25-year range between 1.4 and 2.1 to the dollar. Right now, it is desperately trying to hang on to key support level of 1.5, and when it inevitably breaks, the, quote, George Soros low of 1992 at 1.4 per dollar will be recalled as the good old days of moderate British inflation. Back to bond yields, let it sink in for a second that January was the best month for bond prices in nearly 5 years, partly due to fear of the depression that has unquestionably consumed the world, as depicted by the Baltic Dry Index yesterday hitting an all-time low, and partly due to the rapidly growing understanding that QE to infinity and negative interest rate policy are here to stay, the inevitable final phases of history's largest Ponzi scheme. And not only are central banks being forced to monetize bonds simply to keep services down as global debt loads go parabolic, but to reduce the attractiveness of currencies in a desperate attempt to improve manufacturing competitiveness amidst the weakest economic conditions in generations. The fact that such competitiveness, with quotes around it, is but a sham, is that any increase in export revenues received due to a weaker currency are worth less. Not to mention, as the Japanese have shown demonstrably, a weaker currency decidedly does not yield increased manufacturing jobs, especially when competing central banks are all deploying the same policy. And nothing speaks of just how pervasive this practice is becoming than the fact that in recent weeks, essentially every Wall Street and MSM publication is loudly discussing the quote, global currency wars I first warned of more than 2 years ago in yet another must-read article titled The Final Currency War. To that end, how comical has it become that anyone still pretends the Fed is considering rate hikes in 2015, let alone ever? Just 1 month ago, the FOMC consensus of the overnight Fed funds rate at the end of 2016 was 2.5%. And yet, the 30-year Treasury yield closed Friday, that is yesterday, at an all-time low of 2.22%. In fact, since QE ended in October, ended with quotes again because the Fed does plenty behind the scenes, and talks of an imminent rate hike commenced, the 30-year yield has plunged from 3% to said 2.2%, and the 10-year yield from 2.3% to yesterday's multi-year low of 1.64%. The Fed has all but maintained its goal of 2.0% CPI inflation, which is now running closer to 0% as utilized in yesterday's GDP deflator. And clearly, the March or April 2015 rate hike expectation Janet Yellen herself predicted in December are as realistic as a snowstorm in July. Current rate hike expectations have already shifted into 2016, and in my view, the next rate move will not be higher but lower, as in the negative interest rate cancer rapidly engulfing the world. In fact, just one so-called hawk sits on the 2015 FOMC voting committee. But even he, Jeffrey Lacker of the Atlanta Fed, made significantly more dovish comments in August, and this before oil and commodity prices crashed and the dollar exploded. Of course, the most damning statement of all, of why no matter what the Fed does, it will be swamped by the unstoppable tsunami of reality, was uttered yesterday by Philadelphia Fed President Charles Plosser, who espoused exactly what I've been saying all along, i.e., the market forces are going to overwhelm us. We're not going to be able to hold the line anymore. And then you get that rapid snapback in premiums as the market realizes central banks can't do this forever. And that's going to cause volatility and disruption. Back to NIRP, or negative interest rate policy, the ECB started that death trend last summer, and the Swiss took it to a new level of lunacy last month, just before it was forced to depeg the franc from the euro. It has subsequently taken rates deeper into negative territory, to the point that even 15-year Swiss bonds are trading at negative yields, prompting Keith Weiner to write an extremely ominous article about how the franc itself is on death's door. Taking this financial suicide an order of magnitude further, the Danish central bank has now reduced rates deeper into negative territory 3 times in the past 2 weeks, as it too has its currency, the krona, pegged to the euro. Gee, I wonder what will happen there. And to that end, try to get your minds around this incredible tidbit which I just read in Zero Hedge. Yes, NIRP has so badly distorted the Danish economy that at least one Danish bank is now offering negative interest rate mortgages. Yes, my friends, this is truly the end game in plain sight. When banks are so desperate for deposits, they are paying you to borrow whilst you pay them to save. As for interest rates in general, words cannot express just how rapidly they are plunging worldwide, with the exception, of course, of nations like Greece and Brazil that have already gone into their final death throes. The U.S. 10-year rate has fallen from 2.3% at the December 17th FOMC meeting to 1.64% today. But that's nothing compared to what's going on in Europe, curved the maniacal QE policy announced last week by whatever it takes Draghi, simultaneous with an all-time low Eurozone inflation rating. Germany's 10-year yield plunged 6 basis points, or 17%, yesterday alone to a record low of just 0.30%. Nearly overtaking Japan's Abenomics-destroyed yield of 0.27%. In Switzerland, the 10-year yield is solidly negative, and even the 20-year yield is barely positive. In the UK, the 10-year gilt yield fell from 1.42% to 1.33%, again, yesterday alone. And even in Canada, where the loonie plunged below key support to a new 10-year low yesterday, the 10-year yield plummeted from 1.36% to 1.25%. Again, yesterday alone. In other words, exactly what I predicted last May, to the mockery of Wall Street, Washington, and the MSM alike, which is that all Western rates are headed to zero, and in some cases negative territory, as the entire world realizes that, quote, deflation or otherwise, the final currency war has now gone nuclear. And thus, the most slam dunk investment thesis of all time has become the front running of QE to infinity, other than, of course, the purchase of physical gold and silver to offset the resultant ruination of the entire global fiat currency system. And then, of course, you have the utter collapse of the world's largest trading bloc, Europe, and political union, causing the world's most widely utilized currency to implode under the threat of imminent default, hyperinflation, and historic social unrest. Regarding the latter, I'll spend more time discussing it in my next article, which I already guarantee to be must-read material, even before it's written. And as for the former, do people not realize just how close Greece is to catalyzing the end of Europe as we know it, and potentially with it the mirage of European banking system solvency? That, trust me, no amount of QE can save. I mean, Syriza has only been in power for 5 days, and already they have wreaked havoc with the supposedly all-powerful Western political and banking cabal. Alexis Tsipras has already made it clear that everything he promised he will accomplish, starting with the write-down of most or all of Greece's 300+ billion euros of debt, and likely ending with secession from Europe. In both cases, the financial losses involved will be catastrophic and unbailoutable, unless, of course, the ECB, Fed, and other central banks choose the hyperinflationary route, which undoubtedly they eventually will. Yesterday alone, Greece basically ended all negotiations with its hated foe Germany, thumbing its nose at Troika austerity requests and essentially telling it to go to hell, which is exactly where all of Europe is going, or more accurately, the financial hell referred to in the title of Thursday's audioblog. Speaking of catchy audioblog titles, I don't think I've ever been as spot on as this week. Not just with Thursday's FOMC lunacy opens the gates of financial hell, but Tuesday's 3 historic central bank failures in 1 week, do I hear 4 or 5? As for Wednesday's catastrophic pre-FOMC drift failure portends the Yellen reversal tomorrow, I may not have been exactly right regarding the wording of Liar Janet's statement. However, the ugly post-FOMC market movements validate exactly what I surmised regarding the power that be's visibly weakening grip on perception, which ultimately will accelerate the arrival of the aforementioned Yellen reversal. Regarding said historic central bank failures, the horrific plunge in European interest rates and the euro itself following last week's suicidal QE announcement all but destroyed the ECB's credibility, just as the Fed's insistence on ignoring economic reality in Wednesday's FOMC statement destroyed the last vestiges of its own credibility. But far more importantly, the fact that not only did precious metals rise and the Dow plunge amidst the FOMC statement period depicts a dramatic weakening in the power that be's manipulative control over markets, suggesting that what I wrote in yesterday's article, all they have left, is already coming to pass. In other words, the only remaining markets that the PPT, Fed, Exchange Stabilization Fund, and cartel haven't yet lost control of, i.e. the Dow Jones Propaganda Average and paper gold and silver, are too on the verge of being swamped by reality. To that end, my shock in watching the Dow plunge 290 points, whilst gold surged $14 an ounce the day before the FOMC statement, was nothing compared to my incredulity in seeing, despite the aforementioned manipulation agency's best efforts, the Dow plunged 250 points yesterday, whilst gold surged $27 an ounce. And this on a COMEX options expiration day, the day after a massive paper raid and subsequent increase in silver margins aimed at destroying paper prices. Lately, I've been using the words historic and momentous quite often, which frankly could be justifiably supplemented with unprecedented, ominous, and terrifying. I've been referring to everything from the accelerating economic collapse to plunging currencies, commodities, crude oil and interest rates, and central bank credibility, as well as surging global gold prices, exploding geopolitical tensions, and rapidly expanding currency wars. However, few days characterize all of the above better than yesterday, starting with the ugly Greek debt negotiations, which as I write Saturday, just escalated dramatically with an outright ECB ultimatum to agree with the Troika by February 28th or have all Greek aid cut off, and finishing with a credibility killing yet lower than expected U.S. GDP number, culminating with a sum of all powers that be fears close to Friday's trading day. Yes, 'twas early Friday morning, and again stock futures were higher, as they always are. Horrible European inflation, or should I say deflation, data, a dramatic expanding Greek crisis, oil prices sitting at 5-year lows, and the Chinese yuan threatening to break its own ill-conceived dollar peg. Moreover, following Thursday's blatant paper precious metal attack to calm, quote, gold fever, with COMEX options expiration just hours away, gold and silver, of course, had barely recovered from their Thursday closes. And then, at 8:30 a.m. Eastern Standard Time, one of the ugliest GDP reports to date was published. Not just because the headline print of 2.6% was below the 3.2% estimate, but as always with U.S. government reported data, because the internals were so ugly. For one, the GDP deflator of 0 was well below the expected 1.0%, as well as last quarter's 1.4%. In other words, no matter what metric one uses, real GDP was blatantly goosed by downward fudging of the deflator. Second, as was the case last quarter, the single strongest component of fourth quarter, quote, growth was personal consumption expenditures on, drumroll please, healthcare. In other words, a combination of population aging and mandatory Obamacare-related spending, which for some reason the BEA deems economic growth. And last but not least, fourth quarter business inventories had their second largest quarterly increase in the past 15 years. In other words, not growth at all, but the seeds of economic contraction, as now that those GDP-boosting inventories have been factored into GDP, future quarters will see significant GDP-crushing inventory depletion. In other words, as poor a GDP report as you'll see, much less as despite historic book cooking and Fed QE, much less as despite historic book cooking and Fed QE, 2014 GDP growth was no different than the well below average rates of both 2012 and 2013. Consequently, Dow futures were down 175 points at the New York Stock Exchange Open, or, drumroll please, exactly 1.0%, i.e. what I long ago deemed the PPT ultimate limit down. But lo and behold, for no conceivable reason, with absolutely no incremental news or material market movements, the Dow recouped all its losses in the first 10 minutes of trading, as clearly the PPT was desperate to prove the GDP report wasn't as bad as perceived, or for that matter, Wednesday's FOMC statement. Amazingly, the cartel pushed silver from modest gains to a 10-cent per ounce loss, whilst gold was nearly pushed into the red as well, and this with treasury yields plunging and oil and copper prices at their lows. At 9:45 a.m. Eastern Standard Time, the government poured on the BS by posting an increase in the Chicago PM Diffusion Index, which, by the way, was the poster child for July's Island of Lies article, followed by, get this, the highest consumer confidence number in 11 years. I mean, there was simply no manipulative stone to be left unturned Friday, and briefly it appeared they would succeed in their evil aims. However, as the morning moved on and the Greek negotiations became more cantankerous, and the big Baker Hughes rig count completed its second biggest 8-week drop in 22 years, the Dow plunged anew, whilst PM surged higher. But yet again, the Dow's losses were stopped at exactly 1.0% before yet another spirited rally based on nothing. In fact, it again almost turned positive, whilst the Nasdaq actually did. However, just as Wednesday, when the catastrophic pre-FOMC drift manipulations failed, the Dow again started plunging, whilst gold and silver broke through numerous cartel herald algorithms and continued to rise. Worse yet, in the day's final hour, just as on Wednesday, gold surged to its high, whilst the Dow plunged, soundly violating cartel rule number 1 for the second time in 3 days. In fact, gold's $27 per ounce gain completely erased yesterday's $26 per ounce loss, whilst the Dow's 250-point loss completely erased yesterday's 225-point gain. PP-induced, of course. Truly ugly market action, and this despite a late-day crude oil short squeeze that theoretically should have turbo-boosted the PPT's typical Hail Mary algorithms. And capping the power that be's horror off, a renewed dollar surge caused gold to explode higher in numerous currencies, particularly the Australian dollar, causing Australian-priced gold to rise 4.5% yesterday alone to within 9% of its all-time high. That is, the power that be's horror was capped only momentarily, as when the weekly COT report was published by the CME, the entire world realized just how desperate their efforts to slow precious metals' rise have become, in what is rapidly morphing into the beginning of the end of 2 decades of cartel ignominy. To wit, I earlier this week discussed how in fighting the cartel for 13 years, I am finally starting to feel like Neo in the Matrix, when he all of a sudden realized he was more powerful than an entire army of Mr. Smiths. In other words, the cartel is huffing and puffing with all its might, as exemplified with its commercial short position quadrupling in the past 2 months, to its highest level in more than 2 years, but failing to prevent gold from exploding higher. However, physical demand is rising so dramatically and inventories depleting so rapidly, not to mention as production is set for an historic decline, that all the naked shorting in the world is having no effect. Finally, it appears, the cartel has run into the aforementioned unstoppable tsunami of reality, and watching global currencies collapse, yielding explosive PM demand, it couldn't be clearer just how close the so-called New York gold pool is to being destroyed. And just wait until the Chinese inevitably depeg the yuan from the dollar, perhaps in Swiss bank-like blitzkrieg fashion, at which point not only will the high of $1,300 an ounce, the line in the sand, be a distant memory, but likely 2011's all-time high of $1,920 per ounce as well. Again, the focus of yesterday's Last to Go article was the fact that the only manipulative tools the powers that be haven't yet lost control of are major stock markets like the Dow Jones Propaganda Average and, of course, paper, gold, and silver. All else has been decidedly lost, and nothing can stop the tornado-like winds pushing their trends in the wrong direction. To that end, I am extremely interested to see if the powers that be can regroup next week, starting with the efficacy of their guaranteed Sunday night sentiment attempt on PMs, which has succeeded on 83 of the past 84 weekends. If not, the window of opportunity to protect yourself will likely have contracted dramatically, as not only has the big one clearly commenced, but the last remaining manipulation weapons will be universally understood to be failing. Friday afternoon, Eurogroup President Jeroen Dijsselbloem was inadvertently heard telling new Greek Finance Minister Yanis Varoufakis, "You have just killed the Troika." If so, good riddance, and even more so to the gold cartel, as if Dijsselbloem is correct, 20 years of gold and silver suppression will undoubtedly end in a flash, making it extremely difficult to procure real money at any price, let alone today's historically undervalued levels. To that end, if you decide to take action by buying or storing precious metals, which ultimately can not only save your finances but afford you the opportunity to join the new 1%, we hope you'll call Miles Franklin at 800-822-8080 and give us a chance to earn your business. And as always, I can be reached via email at ahoffman@milesfranklin.com. Thanks very much.